I think the pullback you just saw is a buying opportunity. Again, when you put it in perspective of what has gold done since the government legalized it. Well, it had a bear market low in 1976 after hitting 200, and when it was legalized, it dropped to $103. Mid 76. Between mid 76 and 1980, 3.5 years, it went up eightfold. And the conditions that drove that, we argue, are far less dynamic than the ones we're sitting on right now. Okay, two. The next bull market started in 2001 from a $260 low and went to 1920. Eightfold move. Spanned 10 years, but an eightfold move. Okay. We're only fourfold off the bear low, $1,050 in 2015. So people say, oh, it's overdone, it's overdone. There's another argument that it's just beginning. And it's the first charts I sent you. The first chart shows a spread relationship between an ounce of gold and the price of the S&P 500. And it goes back to 2013. Remember, gold peaked at 11, and 2011, 12, 13 especially, it's entered a bear market, which didn't bottom until 2015, end of that year. During that time, it was underperforming the S&P 500. The spread was collapsing along with the net price of gold. But then, in the 11 years since that, during an 11-year period of that basing process, there have been 4 rally highs in the spread, meaning gold has had a rally versus the S&P relative performance-wise. And each of those rallies, by the way, was actually strong upside in gold, net price. But there's a clear base that a kid with a crayon could draw a line across. 4 separate peaks that are almost flat. You're pushing at that line now, again. Right now, the spread between gold and the S&P is 58.6%. Ounce of gold, D's gold, using D's front month future, S&P. If you ever close a month at 60%, and we were intra-month above that last month, you ever close a month out at 60% on that spread breaks out of an 11-year relative performance base. It says, I'm just beginning. Again, when the spread moves up, net price of gold's moving up. So that chart says, as an asset class choice, stock market or gold, it'll break out versus the S&P in saying it's just beginning. And then it's not broken out yet versus the S&P. But we also ran the spread of gold versus the New York Composite Index, which doesn't have a front end weighting of 5 stocks that constitute 30% of the overall index, like S&P, or 5 stocks in the NASDAQ 100 that constitute 50% of that index. Okay. I measured it against the New York Composite and the Dow 30, same time span, 2013 to present. They've broken out. Already gold is broken out versus those two front-end loaded indexes of the U.S. stock market. The only thing that's kept it from breaking out against the S&P is, again, handful of those front-end stocks. That's it. That's the only thing. The broad market really gold's broken out. It says the game has just begun. I'm now a better place to be in the stock market. The one thing I forgot to talk about was the silver-gold relationship.
Okay.
I argued that silver is going to explode, but you can maintain a spread chart where you divide an ounce of silver into an ounce of gold, express it as a percent. A lot of people do it the other way. It's a ratio chart, but we do it ounce of silver into gold. And right now, silver price is about 1.2% of the price of gold. If you go back and examine what happened in those 2 prior bull markets, at the phase where silver went ballistic, we had been going up for a couple of years, 75, 76, 77, 78, 80 finally. In the last 6 months of that move, silver went quadrupled in price. It had already been in a bull. It wasn't like it wasn't a bull then. It just said, I'm gone. Okay. And in 2010, September of 2010, 6 months before silver reached 50 again, in April 2011, it doubled in half. In 6 months, okay. You want to quadruple silver from where it is now, you're talking 200, okay. You want to double in half, well, you're talking, 125, whatever, okay. What was a signal back then that event was going to occur? Because when you looked at the price charts, they were already going up. So it wasn't a big deal that they just went up faster, okay. So the price charts weren't telling you. You'd already been in a bull trend. The spread. Divide the ounce of silver into an ounce of gold and plot it month to month. And sure enough, back then, even while silver had been going up for a couple of years along with gold, 76, 77, 78, 79, okay. it was going up less, and therefore the spread was deteriorating. Silver was underperforming the advance in gold, so it looked negative on a spread chart. It was still making money, but it wasn't as much as gold. The spread built a structure, and it ran up to a level, pulled back, ran up to another level a year later, pulled back, and when it came through that level, the spread broke out. And that told you silver's now going to beat gold. That's what set off the fuse. Same thing happened in 2010. You'd had a depressed action by silver to gold. It built a spread dynamic that you could see, draw a ruler across it. And in September 2010, you broke out, and that's when the price of silver went ape. We have a very similar situation on the chart I sent you. There's two charts there. One is the spread chart at the top, and you can see there's a red horizontal line on it. Comes to just above 1.3%. Again, we're right now at 1.2%. You ever get a monthly close above 1.31%? Actually, it's where those precise two prior highs were going back 4 years. That breaks out and it says, I'm out of here. And you're still at very cheap historic values of silver to gold. Heck, 20 of the past 50 years, silver's at least been 2% price of gold. Well, heck, if you go from 1.2 to 2, that's a huge multiple. I mean, silver is almost doubling in value to gold. And in bull markets, going back 50 years, during the 79-80 move and the 2010-11 surge, silver reached well over 3%. So from 1.2 to 3, well, wow. Okay, huge potential multiple. The key is to break that spread out. Now, the chart below the spread, pardon me for getting scientific here, is a momentum of the spread, where we measure the spread in relation, oscillated versus its 10-month average. And you should have the same picture. Dual highs, you want to break through them. Well, heck, it's September, we closed on the line and backed up ever so slightly into October. It won't take a hair's breadth to break out the momentum above its ceiling. And when it does, you can bet that the spread will follow. So those are the metrics we're watching that tell us the clock has begun, the clock for the go into a new reality.
If you look at what just happened in the metals, you'll see exactly what I've been saying for months. The pullback we just saw is a buying opportunity, not a warning sign people panic, because they look at the headlines instead of the history. But if you zoom out, the patterns are astonishingly consistent. Gold always moves in cycles, deep, powerful cycles that run for years. And when those cycles turn, they don't just nudge prices higher, they send shock waves through the system. Let's go back and put this in perspective. When gold was legalized again in the United States in the 1970s, it had already climbed to about $200 an ounce before dropping sharply to $103 in mid-1976. That was the bear market low. And what happened next was one of the most explosive moves in financial history. Between mid-1976 and 1980, over just 3.5 years, gold went up eightfold. The conditions that drove that were significant: inflation, deficits, a loss of confidence in government. But they were mild compared to what we're sitting on today. Think about that for a second. In 1976, total U.S. debt was under $1 trillion. Inflation was painful but temporary. Today, we're north of $38 trillion in debt, and inflation isn't transitory. It's structural. Back then, they had Volcker and political will. Today, we have 5% rates and $1 trillion of new debt every 2 months. So if gold could go up eightfold then, what does it do now when the foundation of the system itself is cracking? And that wasn't the only eightfold move. The next great bull market started in 2001, from a low of around $260 an ounce. Over the next decade, it climbed to nearly $1,920 by 2011, another eightfold move. That one was driven by the explosion of the derivatives market, globalized debt, and the birth of QE, the era of free money. Now here's where it gets interesting. The current bull began in 2015, when gold bottomed near $1,050. Since then, we've quadrupled, but that's still only halfway to the kinds of gains we've seen in every prior major bull market. People keep saying gold is overdone, that it's priced in. But based on history, it's not overdone. It's underappreciated. The real move hasn't even begun yet. I often tell investors, stop staring at price charts and start looking at relationships. Relative performance tells you far more about what's really happening than raw price data. One of my favorite tools is the spread between gold and the S&P 500, an ounce of gold divided by the price of the S&P. When that spread rises, gold is outperforming stocks. When it falls, stocks are outperforming gold. Simple, right? but the implications are profound. If you look back to 2013, after gold's 2011 peak, gold entered a deep bear market. It bottomed in late 2015, but since then, the spread has been building a beautiful 11-year base. 4 rally peaks, all hitting nearly the same ceiling. You could literally draw the line across it with a crayon. Every time gold approached that ceiling relative to the S&P and pulled back. Until now, as of this moment, gold trades at about 58.6% of the S&P 500's price. If we close a month at 60% or higher, and we were already intra-month above it recently, that's the breakout point. That would mark the official end of the 11-year base and the beginning of a massive new phase where gold not only rises in price, but outperforms the stock market. Now let's be clear, gold has already broken out relative to other major equity indexes. Against the Dow 30 and the New York Composite Index, gold's breakout happened months ago. Those are broad, balanced indexes that don't have the same front-end loading as the S&P 500, where 5 mega-cap stocks make up almost 30% of the index. So in the broader market, gold is already winning. The S&P is just lagging because of a handful of tech giants that have distorted everything. That's why I say the game has only just begun. Once those big-cap tech names falter, and they will, the spread will explode higher, confirming that gold has officially become the better asset class.
My view of the 60-70 range is gone. I no longer have that view. I now think you could go to 100 to 200 in the next couple quarters. We've done a lot of technical rationale for that. It's not just a gut feeling, okay? But we've shown that if you look at silver on a chart, just an arithmetic chart, go back to 1975 when gold was legalized. Gold has had huge surge up, then a pullback and a range for a decade. Then another huge surge up and a new higher range for a decade plus. And now is into another surge, which is, by the way, only half as strong so far, measured logarithmic scale, ratio scale, to the prior 2 bull markets. If gold matched them, it'd be $8,500. Okay, but how come silver is stuck in this box for 50 years? We showed charts of copper and lead, okay? Real exciting stuff, lead, But in the 70s, 80s, 90s, and into 2000, they were stuck in a range, sort of like silver is now still stuck in. And in 2005 and 6, copper quadrupled in about a couple quarters. It just left that old reality behind. And then over the subsequent decades, a new range that if you divide the middle of that range it's lived in for the last 15 years or so, it's 4 times what it was between 1970 and 2005. Okay, how come silver's still stuck in that range? Then we look at lead, and lead had the same situation for multiple decades, caught it at a price range, blew out of it in 2007, not in sync with copper on its own stuff, quadrupled in price in a matter of a couple quarters, and then lived in a new reality, way above that old reality. How come silver's here? Well, there's some arguments that are likely valid that, it's been artificially depressed, suppressed, etc. But whatever the reason, you can't fake reality forever. And if gold, the other monetary metal, has gone from, a peak in 1975 at 200, then in 1980 was 850, and now we're 4,000. And yet silver in 1980 was 50 and we're at 48. Okay, now something's wrong there. Forget any intricacies of special situations. What's going on? I mean, lead's 4 times its price then. Copper is silver, anyway, there's a point to be made there. Sometimes markets make mistakes. We know that. As an investor, if you're around long enough, you've seen bubble markets make a peak. And when it falls apart, you look back and say, oh golly, now I can see why. It was irrational, too high for too long. Even if the concept underlying it was valid, it just went too far too long. And the same thing goes on the downside. Markets make mistakes on the downside. They get down too low. They lay there. Nobody likes them. They're not doing anything good. So who's going to invest in them? And then when they wake up in a thunderbolt. The technicals of silver right now argue to us. Now we've got one trigger level that we'll talk about in a minute, that when it's triggered, we think over the following 2 quarters or so, in other words, 6 months or so.
I've been saying it for years. Big market turns don't happen when everyone's bullish. They happen when everyone's distracted. And right now, the average investor is still hypnotized by technology stocks and crypto narratives. They think this is 2013 all over again. It's not. The spread structures we're seeing in gold and silver haven't looked this strong in decades. Let's start with gold again, because it's leading the charge. When I say we're at the edge of a breakout versus the S&P 500, I'm not talking about noise. I'm talking about a tectonic shift in where capital is flowing. Money doesn't lie. You can manipulate headlines. You can distort CPI data. You can even massage GDP numbers. But when you see an 11-year relative performance base being tested, that's not politics. That's math. Gold has already broken out against most global equity markets. Against the Dow, the New York Composite, the Euro stocks, and even emerging market indexes. The trend is clear. The only thing keeping it from an official breakout versus the S&P are those few mega caps that everyone believes can defy gravity forever. But when that illusion fades, and it will, the spread will blow past 60%, confirming what the momentum structure has already been shouting. Gold has entered a new bull era. People forget that the stock market's dominance over gold since 2011 wasn't because gold got weak. It was because tech valuations went parabolic. The Magnificent Seven created a mirage of strength while the rest of the market quietly deteriorated. Look at the Russell 2000. Look at breadth indicators. The majority of U.S. equities are already in long-term downtrends. The bull market narrative is being held up by a handful of AI darlings and trillion-dollar balance sheets. When that concentration unwinds, the flow into gold will be unstoppable. Institutions will be forced to rebalance. Pension funds, hedge funds, and sovereign wealth managers who ignored metals for a decade will rediscover them out of necessity. That's when you get verticality, not just steady gains, but explosive repricing. Now let's talk silver, because this is where things get exciting. Silver's relative underperformance over the last few years has lulled people into complacency. They think it's dead money. But historically, that's always what silver looks like before it rips higher. It's the coiled spring of the commodity world. The spread chart between silver and gold, silver as a percentage of gold's price, is the single best forward indicator of when that coiled spring is about to uncoil. Right now, we're sitting at 1.2%. We've got that red horizontal line around 1.31%. That's the line in the sand. Once we close above it, that's your ignition. And here's where it gets fascinating. Momentum is leading price. When the momentum of a spread breaks out before the spread itself, it's like a storm warning. You can feel the pressure drop before the lightning strikes. That's where we are now. The momentum oscillator is already flirting with a breakout, and it would take only a fraction of a move between now and month end to confirm it. When that happens, silver won't just go up, it'll go ballistic. We've seen this pattern 3 times in the last half century. Each time, silver lagged gold for years, built a base, and then broke out relative to gold. Each time it triggered a parabolic move. 1979, 2010, and now. The setup is identical. So when I hear people say silver's cheap, they're missing the real story. It's not just cheap, it's primed. Let's talk numbers. The average gold-silver ratio over the last 50 years is about 55-1. Right now, it's closer to 80-1. Historically, every time that ratio breaks lower, meaning silver outperforms, it doesn't stop at 70 or 60. It overshoots, sometimes dramatically, going to 40-1 or even 30-1 during speculative manias. Do the math. If gold goes to $4,000 and the ratio falls to 40-1, that's $100 silver. If it falls to 30-1, which it did briefly in 1980, that's $133 silver. And those aren't fantasy numbers, they're historical precedent. So when people ask me, Michael, is silver really going to triple or quadruple? My answer is, it doesn't have to, it just has to normalize. The normalization itself is a multiple. Now let's put this in the macro context. Why are these spreads building? Because the monetary world is shifting beneath our feet. The debt structure of the United States, and indeed the entire Western world, has reached the exponential phase. Government debt has outgrown the productive economy, and the only way out is through devaluation. The Fed can't normalize rates because every 1% increase adds $400 billion in annual interest payments. They can't do austerity because that would trigger mass unemployment. The only option left is manage inflation, letting the currency weaken while pretending it's under control. And that's exactly the kind of backdrop where gold and silver thrive. Look around the world. Central banks are buying record amounts of gold, over 1,000 tons last year alone. China's doing it. Russia's doing it. Even countries like Poland and Singapore are quietly diversifying their reserves. They know the fiat endgame is approaching. Meanwhile, the West is still in denial. The Fed talks tough about tightening while quietly preparing the next round of quantitative easing. The Treasury is issuing short-term T-bills because there's no demand for long bonds. That's a liquidity trap masquerading as policy. All of this feeds into the same conclusion. Real assets are reclaiming their place as the foundation of value. That's why I tell investors, watch the spreads, not the headlines. When you see the gold/S&P spread breakout, you're witnessing capital rotation in real time. When you see the silver/gold spread breakout, you're witnessing the ignition of monetary panic. And here's the funny part. People think they'll have time to react. They won't. When these breakouts occur, they happen fast. By the time the average investor realizes what's happening, the easy gains are gone. That's why I keep hammering this point. These pullbacks are opportunities. They're not corrections. They're pit stops before acceleration. If you think you missed the move because gold's already doubled from its lows, think again. In every major bull cycle, the first doubling was just the warm-up. The real parabolic phase came after the breakout in relative strength. Exactly what's happening now. So yes, the conditions today make 1979 look like child's play, debts higher. Leverage is systemic. The fiat experiment is unraveling. And the technicals, both momentum and spreads, are telling us the same thing. The clock has started. We're not near the end of this bull market. We're standing at the beginning of its vertical phase. That's why I keep saying, hold your metals, add on dips, and don't get shaken out by volatility. The future is going to belong to real assets again. And for those paying attention, this is the opportunity of a generation.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.